think we're in for a treat today. I'm very pleased to welcome and introduce Dan Zoppo to this month's Analytica Expert webinar on applied real options analysis. I first learned about Dan from seeing his blog at Freehold Finance, which has quite a few interesting articles on probabilistic approaches to dealing with finance, many of which use Analytica, one of which has an interesting comparison of Analytica with other tools. So when we learned about him, we thought we would be delighted to invite him to come give one of our Analytica Expert webinars. Dan's a finance professional with background in asset valuation, investment decision-making, market research, with a range of industries, especially commercial real estate, healthcare, wind energy, agriculture, and more. And he has a BA in physics and economics from Boston University, MA in math from CUNY, and JD from the University of San Diego, and is a member of the California Bar Association. Maybe at some point Dan will explain how these things go together, so Dan, how did you first learn about Analytica?
I actually learned a lot about Analytica because I was doing some commercial real estate valuation, and I was tired of using Excel, and I had used the R programming language in grad school. And so I did some Google searching, and I came across this business case study using R by Robert Brown. And he, after I Google searched him, his website had recommended Analytica as the go-to tool. And so that's kind of how I came across it. And I've used it practically every day ever since.
Wow. Okay. And so I don't know if we're willing to say a little bit about why you use, or how you decide to use Analytica versus other tools. Why do you like to use it?
I think the primary reason I use Analytica is for the array programming features, the intelligent arrays. I mean, the model that I'll talk about in this talk, at one point, I think it has up to like 4 dimensions, but when you're actually operating over the model, it's, one line, it's seamless. And to me, that is having programming experience. I mean, I'm writing a web page and using the Go programming language, which is very procedural. So just the array capabilities I think are ideal for scientific computing and financial modeling.
Very good. So what are you going to tell us about today?
So today I'm going to talk about real options analysis. Let me have so yeah, Max mentioned I have a web blog, freeholdfinance.com, and I'm going to put the model up that I talk about today, and feel free to reach out to me. So here's the outline. I'm going to address why real options, why I am interested in real options, how it relates to my background. Then I'll address some of the just basic theory. There will be a couple equations, but I am including them not to overwhelm people, but I hope that they add some intuition as to how the algorithm actually works. And then I will present the algorithm in 3 different ways. Once in English, once using, this is another great feature of Analytica, is the different ways that you can model the same algorithm. So I'll present it once as a dynamic function algorithm, and then once using iterate and with the full influence diagram coming into play. So let's begin. All right, so why did why am I interested in real options? And this relates to, I had, as Max said, consulting experience in a number of industries, but I also have real estate development experience for our own account, where we're the project managers, the developers, equity, all phases of the projects. And to give an example that integrates with this real options talk is we were just looking at doing a 24-unit housing subdivision, and the permitting authority actually mandated that we would have to put in all the roads and all the site utilities and perform a significant amount of the site work prior to issuing any of the occupancy permits, meaning we couldn't sell any of the units. So we had to pass on this because the project did not have the managerial flexibility that we needed to minimize our risks. Instead of phasing the project as 5 units at a time, we would essentially be doing all 24 at once, and that's a significant risk. And so what I realized is the way that we were managing projects was very different than the way that we were valuing these projects using static net present value, internal rates of return. And back in school, being an economics major, I remembered a book by Dixit and Pindick called Investment Under Uncertainty, and it was a treatise on real options. And they actually dedicated the book to the future, and that stuck with me. And so then I realized that there had to be better valuation techniques. So I started reading the literature, which got me into real options. So which brings us, what can we do with real options? And real options, the analysis we're going to go over has 2 primary purposes. One is for valuation, which is my focus and my interest. And then the other is you can actually use it to build optimal controls and policies. For example, if you had a mine, at what price would you open the mine and operate? At what price would you close, conditional upon your inventory? You can use these methods to solve for those operating policies. I've seen this regression Monte Carlo methods have actually been used to develop operating policies for microgrids and even some robotics applications. So this goes well beyond financial valuation, although that will be my focus here. So here is a definition. Eduardo Schwartz is he is the S in LSM algorithm. He is a pioneer in this field. He's done a tremendous amount of work, mostly related to commodity valuation. And he defines real options are contingent decisions that provide the opportunity to make a decision after uncertainty unfolds. So I think the key takeaway is that real options are about the interplay of a business decision maker responding to new information that they encounter. And I mean, for me personally, that's pretty much, every day at work, it's always new information. There's always a new problem that has to be solved. And so in reality, a firm can kind of be thought of as a bundle of real options. I mean, real options is how we are actually operating our businesses. So that's why I think that it may help if we actually approach valuation with that understanding. So here are some basic examples: the option to expand, the option to switch, options to learn, options to wait. The switching example, the ethanol plant. At the start of the pandemic, I remember reading on Bloomberg, all these ethanol plants were wondering what were they going to do, and a lot of them switched their operations to producing hand sanitizer, and others were mothballed. So those are options that can be modeled explicitly when you're making the investment decision to either invest or develop a new plant. So to understand real options, I'm going to have everyone recall a formula they've seen 1,000 times before, which is the static net present value formula. And it's simply I'm going to use rho here because I'm going to need it later to be concise, but that's just your discount factor. And it's just the discounted cash flows that you receive. And all time in these models are finite. And I think it's important to point out that the static MPV does not depend in any shape or form on our actions. And that's what we want to include. It's the possibility of our future actions that will change the distribution of our cash flows. So I've updated the static MPV, and we will now call it the dynamic MPV. And I will walk through this so it makes sense, hopefully. So now we have this max operator, and it's over curly bracket AT, which is a full sequence of actions over time. So, action at the initial state 0, and action at 1, action in the final state. So the maximum is that we have to select the optimal set of actions in order to now value the discounted cash flow, which is now also a function of the state ST, which will evolve. And I'll show you this in the model explicitly. A great feature of Analytica is how these equations come to life, really. And so this is, again, high level. And then, of course, the cash flows are now also functions of the state and the action. So we're not going to solve this equation, but this is kind of what we're doing. And I'll show you how to restructure this equation in a minute to put it into an actual model that we can solve with Analytica. But now let's do a simple example to try to fix ideas. Let's say that you have a power plant, you can turn it on or off. Here's your 3-period discounted cash flow stream. So with optionality, you only have to turn the plant on when your cash flow is positive. And without optionality, you always you make the decision at the beginning whether to turn it on or off. So with the static MPV, your value would be 225. With the dynamic MPV, your value would be 325, and this, of course, gives an option value of 100. So that's kind of I think that is actually pretty relevant. I mean, we are always going to have future opportunities to adjust our business processes. And so the next question is the types of options. And again, borrowing from financial options, there are 2 types. There's the European option, which is pretty much what I just showed you. It's at each point in time, at each cash flow, you can make a choice and they don't impact the other decisions. And then streams of cash flows are what we would call a strip of Europeans. And they offer a good first approximation in many models. If I was reading and learning this material, I was reading about how certain peaker power plants are valued, and they are typically valued in like a day-ahead market using this type of European strip model. So it can be used as a good first approximation. And then, however, in many cases, the decisions will flow into each other. So let's say you have a power plant and you have a warm-up period. And this is what we would call an American option. And it will have multiple exercise points when you can turn it on and off, let's say. But the decisions will be linked through time. So if you turn it on, it has to warm up before it reaches full capacity and you could turn it off. So this is a path dependency in the model. And this I will show you explicitly in the real estate development model that we go over. So how to solve these models? There are 3 standard approaches. There are binomial trees and a lattice. They're using partial differential equations in what we call finite difference methods and regression Monte Carlo, which is the topic of this talk. The first 2 methods, they're actually, I guess, technically both lattice methods, but binomial trees are very fast, and I think they're very flexible. So the model that I'm going to show you has multiple states of uncertainty, but there is a single state of uncertainty that is represented as a binomial tree, which I will link to as well, so that if you want to compare them, you can. Partial differential equations, they rely upon some pretty mathematical sophistication in order to use them. I think that regression Monte Carlo, which is the topic of this talk, anyone with really modeling experience, I think, can really latch on to these concepts pretty quickly. There is another big hurdle to using the first 2 to solve a problem, and that's that the fundamental solution algorithm is tied to the stochastic process that you use to represent your uncertainty, whereas using Monte Carlo simulation, we can always switch out to a new stochastic process, as I imagine Analytica users have done all the time. So, how do we restructure this problem, which I will call the sequence problem, into something that we can solve? So this is the same equation before with we're taking a maximum over a full sequence of actions. And of course, how are we going to choose a sequence? It's very difficult. And let's transform the problem into something we call a recursive problem. And so let's assume that we have a sequence of actions and we fix it. And now we can actually begin pulling apart the summation. And so our value v sub 0, that's the value in the initial state period, in the initial state s of 0, is now equal to the cash flow in the initial state, given the initial action A sub 0, plus the discounted sum of the future cash flows. And what we can see is that now we can actually rephrase this to say that the value of the current state is the cash flow, C sub 0, given the initial action, plus the discounted value of tomorrow, of the next state at the next time period. So this is why it's a recursive problem, because now we have these on both sides, and we're going to exploit this in the algorithm. So this will generalize to this kind of scary looking equation, which is called the Bellman equation. And the Bellman equation is now the value is V sub t at S of t is equal to the maximum of a single action at a single point in time. And note that the capital A is a function of the state. And that, again, I'll show you that explicitly in the model that we go over, that our actions at any point in time may be different. They may be from the set of actions may be restricted. But this, we now take the maximum over what we had before. Just to back up 1 second, this V sub 1, the future value, we generalize to the value at t 1 plus 1, and we take the expectation to include uncertainty. And of course, C S of t at 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 is the current cash flow, and the value tomorrow is a function of the future state, which is a state transition function. And again, Analytica will represent this extremely nicely. And of course, this kind of this scary looking thing with the blackboard E is the expectation, meaning that it's a probabilistic representation. Think about it as an average to those who have never seen this before. And we call it the continuation value. So restructuring from the sequence problem, where we have a sequence of actions we need to identify, to a recursive problem, the question becomes, how are we going to value this V sub 1? I mean, what is that object? And in this more general form, it's called the continuation value. And what is it? And we're actually going to use linear regression, what I imagine many people have used many times before. And now in this model, we use ordinary least squares. If you go on Google Scholar, people will approximate the continuation value with all kinds of objects, neural networks, non-parametrics, it's whatever your heart desires. But the traditional algorithm uses ordinary least squares, and it's been shown to be very effective. So that's what we're going to use. And note that a critical thing to note is that we're not using future information in the regression. Let's go through it. I should go through it. So the regression is the sum of the coefficients of the regression. The continuation value is the sum of the coefficients multiplied by a basis function. And I'll talk more about those in a bit, but the basis functions are functions of either the current state or potentially the previous state. We're not using future information in order to estimate the value tomorrow. And that's a critical feature of this algorithm, because we don't want this kind of look ahead bias when we're choosing decisions. So now we come to what are states. And again, I will make this very clear in the model, but states can be decomposed into two types. We have the endogenous state, that which is influenced by our decision, and we also have exogenous states. These are typically our stochastic variables. They are prices that impact the model. They are costs, and the basis function that we just saw is usually a function of the exogenous variables. There are ways to mix these to make the endogenous states also stochastic. For example, if you were managing a hydroelectric, a dam, let's say, you would choose the level of the water, but you'd also be subject to like rainfall and runoff. So there are methods to handle those situations, but they're a little more advanced. So after all that theory, which I hope made some sense, I'm going to get to the actual algorithm. And I'm going to present this in 3 steps. I'm going to first present it in English, and then I'm going to show how to represent the core iteration using the dynamic function, which will demonstrate how awesome Analytica is. And then also we'll go through it again using the iterate function. In practice, iterate saves on memory since you don't need to store the intermediate value as intermediate continuation values. But so let's look first at the English version and just going through it step by step. First, we define our states, actions, and the basis functions to estimate the continuation variable, simulate the stochastic states. Then we calculate the terminal cash flows because we're going to work backwards through time instead of the simulation is forward through time, and then we work backwards through time to solve for the model. And then we iterate, we discount the next period's value. We regress to find against the basis function to find regression coefficients. And then we estimate the continuation value from which we can form an estimated Bellman equation. We determine the optimal action, and then we update the project value estimates. Again, I know this seems like a lot, but hopefully it will be clear when we get to the model. And then we just, in the terminal state, in the first state, we discount the time one's values average to form a continuation value. And then, of course, we solve one final Bellman equation to get the value. So let's look at this in Analytica using the dynamic function. And I mean, to me, it's awesome how similar the statement of the algorithm. It really, this portion is this section 4 and the 6 steps. But I mean, it's very similar. So we start in the terminal state, then we discount back to find what I'll call the next value. And then we estimate the continuation value through first finding the regression coefficients using ordinary least squares regression. Then we estimate the continuation value. We form a Bellman equation, which is, again, the cash flow in the present period plus the value of the project in the future as represented by the continuation value. We find the best actions using argmax, and then we restructure the cash flows. And the reason why we don't use the continuation value here, instead we're using the next period value, is to try to minimize errors that can occur from the regression. So then we have this other kind of Bellman, which is the cash flow today plus the cash flow tomorrow, and then we select the best action. So let's now turn to the model to try to make sense of this.
Dan.
Yeah.
Might also point out that you have the reverse is set to true parameter.
Oh, yes. Yes, that's critical because the way that this works is it's called the dynamic programming algorithm. So we're starting at the terminal as we look at the as we set the terminal cash flow first, and then we're iterating from the future back to the present. So in order to do that in Analytica, we need to set the reverse to true.
So I mean, some of you may be familiar with using dynamic. By default, of course, it goes from time 1 to time 2 to time 3, but if you just set this parameter to reverse, it'll do what Dan needs for this.
So let's look at a sample real estate options model. Now, again, I wanted to, since this is probably a lot of information in a little amount of time, and if you are interested in this, what I did is, this is a semi-realistic model, but I based it upon another paper that solves using a similar setup, but they solve it using a binomial tree solution, and instead I use the LSM algorithm, and I also add another source of uncertainty. And that model you can get to compare at my website, which there should be a link here. Yeah, there's a link there. and this will be there as well so that you can have access to it. But essentially, the story is that we want to build an apartment building, and we have initial square foot, the price per square foot. That's the value today, and actually, and then the cost will have a trend term and a volatility term. Additionally, the price will have a volatility. That is, we are uncertain about the future price of a completed apartment building. So we modeled this with a volatility term, and the same thing for the costs. So let's look. So the first thing to do is we define our endogenous states and our actions. So we have 5 phases in this, and at the start of each phase, we can make a decision, but each phase has a construction time. We can't just do one phase, and this is that kind of path dependency that I was talking about. And so for this model, each phase the first 3 will be 6 months long, and then the last 2 will be 4 months long. So this means that this is our state, again, the endogenous state. And at the bottom, I've added a market state and an abandoned state if we choose to walk away from the project. So phase 1, month 1, phase 2, month 2, etc. Now, of course, we need actions, and the action can be develop, suspend, or abandon the project. And these together will give us the state transition that I had mentioned, or in the equations. So the equations may have looked difficult, but now we have actions, we have states, and these come together to give us a state transition. So in the first period, if we choose to develop, then we just move to the second month of the first phase. If we choose to suspend, we stay in the first month of the first phase. If we choose to abandon, we move to abandon. Note that abandon is an absorbing state, so we will always be in abandon if we select that action. Also, market once you're in market, you will always move to abandon, just to kind of complete the model. So at the start of each of the phases, we have the option to make a decision. But
Dan, sorry to interrupt. What does market mean here?
Oh, the market is when you sell the property.
Okay.
Yeah, I'll show the cash flows, and that will make it clear, perhaps.
Okay.
Thank you. So at the start of each phase, we can make a decision, but within the phase, this is kind of when the action set that I had mentioned in the Bellman equation is dependent upon the state. You can only take one action, and Analytica will ignore the nulls when you take the argmax operator and will return the correct action, which can save memory in larger models. So that's our state transition function. The timing just sets that it's a monthly model over 10 years. And I'll address one of the exogenous processes, that is the exogenous states, that are subject to stochastic LSM, actually, I got a question and it said, what does LSM stand for? And it actually stands for both Longstaff-Schwartz model, the 2 authors that created it, and Lee Square's Monte Carlo. So I guess, ask or type in your questions. So back to the exogenous state of the market process, we need to simulate the price per square foot of a completed apartment building over time. And this, again, uses dynamic, but now we're moving forward through time, and this is just something I put in so I didn't have to rewrite below in the initial period. But the process is subject to a trend, and then also uncertainty is captured through the volatility, through the square root of time, and a draw from a normal distribution. This is called a diffusion process, and these are used heavily throughout quantitative finance in a lot of fields. And let me just note that this is what's called, I only want to touch on this briefly, this is called a risk neutral process. And so what we're doing is we're going to discount all these values at the risk-free rate, and we account for, instead of in a traditional net present value calculation, you use a risk-adjusted discount rate, and this type of modeling, you make the risk adjustment at the simulation. So here are several sample paths. So we start from 150 square feet, and it can go up and what have you. Now, in practice, real estate actually has a high level of mean reversion, and I did not incorporate that in this model. This model is a geometric Brownian motion that essentially is unbounded. So that's just a technical point, but the great thing about this type of algorithm is that the exogenous states are up here, and then they flow downstream to the valuation. So with the binomial tree and the partial differential equations, this probability model would be embedded into the actual valuation portion, which we may not want, because here I could swap this out to be a mean reversion process instead of a geometric Brownian motion. So let's look at a third version of the least squares Monte Carlo algorithm. Oh, excuse me. Let me do so these are the cash flows in each state. Terminal cash flow, of course, in the first run, will only have a value at market. That is when we sell the property. That will be the terminal cash flow, and this is the beginning of the algorithm. And then at each period, we have, these are the slides, these were the cash flows in each period. And if we choose develop, then we will experience a cost. If we choose suspend, then we have to pay a suspension cost and, of course, a salvage value. And then if we're, again, in the market state, we get the market value. And we also have the same for an initial, although this is not stochastic because the initial price is not stochastic. So this, again, is a great way from Analytica to represent the payoffs, given the state, given the action. You just put it in a table or what have you. Note that we could have cash flows throughout the development phase, but for this modeling, we just stick it right at the action or the decision state. So with our period cash flows, we are now ready to look at the algorithm itself. So again, we start in the terminal cash flow state, and then that's the initial estimate of the value of the project's value, and then we discount that value, simply discount factor times the current estimate of the project's value. We run a regression to find the coefficients. Then the continuation value simply approximated from the regression. And of course, the regression is based upon both the discount value and the current basis. So once we have the continue value, we again use the cash flow. That was the table that we were just looking at in the present period, and the continuation value to form essentially our Bellman equation. This is the current cash flow plus the continuation. And then we find the optimal actions for that period. And once we have the optimal actions, we can then update our current period value. Again, we form another Bellman. This uses the current estimate of the project value, and then we take the best action to find the project value. Maybe I'll just go back real quick to, yeah, so this is essentially what we're iterating over. Next period, discounting, estimating the continuation, and then updating the cash flows. This, of course, so I used iterate here because these models can be memory intensive. So when working on something like this, at least even in the beginning, it can be best to use the iterate function instead of dynamic, because even if you're building optimal policies, then you would actually want to store the coefficients. So you don't really need the intermediate value estimates. But this model in particular is solved both ways, which there's one final step, because we need to, again, we need to solve for step 5, discount the project value in period 1, average across all the runs for the period 1's continuation value, and then solve for the initial cost. And that's what this does. This is the period 1 project value estimate. We then average, and we step back, and then we add it to the initial cash flow plus the final continuation value, and we take the maximum of the action. And I just sorted out the states that are the decision state. So for this, I have it stored. So in this run of the model, the value of the project, I'll compare the value of the project versus the net present value. But the last thing, before actually I do that, the last thing I wanted to do to touch on the modeling point of things is, so I learned this trick from one of the example models on an optimal path. And you'll see that several times I use this state equals state transition. If you remember the state transition, if we're in state 5, we go to market. But when we use Analytica, and I think that this is so cool because it makes life so much easier. So this, so let's look at this. We have the terminal cash flow, and the terminal cash flow is indexed by state. But when we index by state transition, this will actually move the terminal cash flow back into the correct period. Hold on. I'll answer questions in a minute. Got distracted. So I think that that's a pretty nice feature of the language. So then let's compare. So the static MPV is extremely erroneous, or it looks very bad in the initial periods. But when we consider option value, that is the ability to either develop, suspend, or abandon the project, we see that they are, it's positive now. And it's positive in the first two, and when it's very negative from a static viewpoint. So the question is, where is this value coming from? So what I did is we can look at the impact of volatility on this model. So I just looked at cost volatility, but we have two sources of volatility, both cost volatility and price volatility. And we could correlate those, which I didn't do, but in a more realistic model, you might want to do that. And looking at the chart, so let's just look at the first period. So if volatility is 5%, the value is what, 761,000. But at 15% volatility, it's over 2 million. So the volatility is what's driving this value, and our actions in response to volatility, as volatility recognizes our uncertainty. Well, I guess that's kind of the model. I know that that's a lot. So any questions? Or I guess there's one question. What determines the reasonable estimate of costs at intermediate time steps? So we actually simulate those costs. So what happens is we have the cost process, which is based upon an initial estimate. And then I don't want to click this because I think it will, because I have 32,000 runs selected. But
could you just reduce the sample size?
Oh, yeah. Let's see. Here we go. Where am I here? Hey, let's just do it. And pull it out. Key is so press it up. So this is how we would. This is how we would simulate costs over time. Okay. And then, so the next question, I guess, is how would you model a vesting period? For example, you cannot abandon the first 6 of the month of the project. Well, for something, a second, So the question is, how would you model a vesting period? And that's something that I think that you would include in the initial phase, for example. Where are we? So you would, for one thing, you wouldn't have, let's say you couldn't abandon at the first time at the start of a project, then you could just set that to null. I mean, I think that that would one way to eliminate that. And then how would you, so then the second question would be, how do you consider cash outflows to investors if specific construction targets are reached? So I think I'd have to think about that one at the moment. But for the moment, this model is more focused on valuation, and so that might be more related to operating policies. But I do have a model on my website that actually goes into the nitty-gritty of construction distribution and how they're actually done in practice, if you want to take a look at that. Okay, so I guess there's another question in chat. Oh, yeah.
Let's see. Dan, I might ask a question here. I guess I'm curious about, what range of problems this technique could be applied to.
Oh, sure. Go ahead.
I mean, for example, for R&D portfolio.
So for an R&D portfolio, I also have an example of that on freeholdfinance.com, but in that situation, you wouldn't have, say, maybe you wouldn't have three options. You would essentially have an option to continue investing at each decision point, or you would want to just abandon. So you could scale the problem down. You could also use a different stochastic process to model the learning process. So each time you invest, you have an updated expected cost of the project. So
for example, for a pharmaceutical company, or you could use it for a bunch of
oh yes, so yeah, definitely. So in the literature, this type of model, and I read a recent review about the applications that this type of real options models are being used for, at least that academics are applying it to. And everything from ethanol plants, like the operating policy of an ethanol plant, power plants, of course, turning on, when to turn off. In those situations, I think they're more looking at operating policies, but also valuation as well.
Well, for power plants, for a generation system where you're trying to look at whether to build new capacity, I know that we at Lumina, James Milford and so on, quite often work in that kind of area. That would be one kind of application. Or another one might be for oil and gas company, which has a sort of portfolio development projects.
Right, yeah.
I see one or two of our customers or folks that are, I think, from work in that area. I don't know if anybody has any specific questions about how you would apply this.
So there's, can you have sensitivity charts? Yeah, I'm sure that you could essentially do all kinds of parametric analysis. To keep it simple, I didn't really do that in this particular case, but certainly, especially with so this, I actually just used Analytica's what if function. So with what if, you can do all kinds of kind of scenario analysis.
See, does anybody else have some questions? I see we have people from, well, a wide variety of backgrounds, but would but you know, I think there might be questions about, okay, well, you know, what is the range you can apply this to? I mean, in general, this is about sort of stochastic dynamic programming, which,
yep.
as we know, is in general is kind of a hard problem. Lonnie Kurzman always tells me, well, you know, whenever you get a new application, it's worth a published paper. But on the other hand, this seems like a pretty general approach. Are you able to say anything about like what the limitations are of when?
Okay, so one of the limitations in this type of model, it has to do with the states. So for this instance, we've actually carved up, and this is something that I myself have been working on because I'm not wholly satisfied with this model. So this model, we have the construction time is entered. And this will give us our endogenous states. But in practice, you know, construction time is something that can be stochastic. And so then when you have the model, whether you suspend production or not, that will change the future cash flows in a certain way that this specific model will have difficulty handling. There are several approaches to handle this issue, but they're a little more complicated. And they are based that this is kind of like the first level. And then like if you have a mine, you know, and you're uncertain about total reserves in the mine as you're extracting, those reserves are kind of your estimate of the reserve is stochastic and it's decreasing. So that becomes will impact your decisions. So there are approaches being taken, but that's also kind of an active area of research.
Good. Let's see. I see a question from Jorge Muro. Can you evaluate the value of a vaccine against leukemia?
Well, I guess I think that you could certainly evaluate. There, it's about establishing, you know, the terminal cash flows, and then again performing the iteration of whether to. So I guess the short answer is yes, but I would have to think about the specifics because it would be about valuing the investment process at each stage. So, like I think like pharmaceuticals have 7 stages. Right? No, excuse me, three primary stages, and then once if it looks viable at the first stage, you move to the second, and etc. The gentleman Eduardo Schwartz, whose algorithm this is, he actually has one of the papers I've reconstructed, but he has a more specific paper for HIV vaccines, actually, that really models the pharmaceutical development process in detail. So I can post a link at my website.
Great, thanks. Well, I mean, I'm super impressed. I was not very familiar with these algorithms at all, but it's exciting to see how you've implemented them. Let's see, anybody else have any questions? Can you share the links to the model and others mentioned in the chat? I actually think they are, let's see, Krista did share the link at the beginning, I think. But
I'll put up I haven't put it to my website yet, freeholdfinance.com, but I will post a link to this model and several other models like that paper on the HIV pharmaceutical paper this afternoon. So
excellent. Great. Any other comments or questions? Well, if not, thanks so much, Dan. I found this truly fascinating and impressive, and I look forward to.
Well, thank you for having me. Certainly, I appreciate any feedback. This is the first time I've given this talk, so if anyone has any feedback, please let me know. Please email me. and I appreciate, thank you for having me. I think this is an exciting topic, and like executing this model in Analytica is just, I've built this model in actually a couple different programming languages at this point, and it's just so much more seamless. I mean, like, I think that this object is like at one point it's a 4-dimensional object, you know, with thousands of runs, and it's just one equation. So thank you.
Okay.
All
Very
right.
good. Thanks a lot, Dan.
All right, bye.
Thanks to everybody for your participation and your questions. And if anybody has any follow-on questions, by all means, you could email Dan directly or email us at Lumina.
And please, I would like to see everyone else talk too. Thank you.
Thanks. Cheers.
Bye.
Bye.